Hey traders, so it's that time of year again when I normally sit down and I audit my trades for the year, Forex stocks, investments, business stuff, and also importantly, my goals that I've had for the year itself. And then, utilizing all of that, I established goals going into 2018. So I would encourage all of you guys to do the same thing. Go back and analyze all the trades that you took throughout this year. If you've got screenshots, go over them, go over your justifications. And what you might find is that throughout the year, you would have grown in what's become familiar to you with each trade. You would have learned something with each trade. And I'm not sure if you guys have been doing this, but with each trade, after you do the analysis, whether it's been a win or a loss, that you write down in your journal that what is it that you've discovered. And what you'll find is that with each subsequent trade, that you're becoming better and better and better, and even just not just what you're seeing on the charts, but also what you're feeling, how you're approaching the markets on that particular day. So please do that. Um, and I've come across my notes that I've written down with sessions that I've done with many of you and emails and messages that have come through. So as a result of that, I've created a bit of a list that I want to go through in this video, and this is going to help you possibly refine your criteria, refine what you're seeing in the markets a lot more. First things first, all of you should now be refraining from trading. Most of the institutional traders have gone by now. And so what you would find is that the markets tend to start doing its own thing. Volumes will drop. The structures will become less frequent as well. So anywhere from, say, the middle of December till about going into the middle of January, take that time off. Study, spend time with family. Again, study the charts, the markets, your criteria, and then really prepare for 2018. Okay? Now, let's go on to the list. Um, the first thing that I want to mention is that with currency pairs, all of you possibly have about 9 or more pairs in front of you. I'm hoping less. But what you've got to ensure each week is that you're not going to be trading all 9 pairs. You're not going to be analyzing every single one of those 9 pairs every day throughout the week. What you will be doing, or should be doing, is on a weekend, on a Sunday or so, go over the happenings of all of the currency pairs for the previous week. And what you're going to start to find is that some of the pairs would have been doing something that you recognize in that week. So, say for instance, if one of the pairs that you like trading has established an Elliott wave structure, so it's done its thing over here, right? And now the market has done a big multi-session, multi-day double bottom, triple bottom, head and shoulders pattern also, and it started to go up, right? And then going on to Friday, there was a correction as such, and now the market's somewhere here. So on a Monday, the market opens up, and it might have either jumped up here and gapped, or it will just start going up, consolidate, and then come down again, do a false move, and then start moving up again. So you recognize this, you take the trade, you capture whatever pips you do. And the thing is that because you've recognized that this is what the market has done the previous week, you're able to some extent predict what the market may do on the Monday, right? So you wouldn't be trading here exactly until the market reached back up to this point, but your prediction will be confirmed by market behavior. So up until, say, this point here, this is what the market would have painted by Friday, right? So on that Sunday, you would be going through these currency pairs, and you look at all of this, and you might say, "Okay, hold on a second. This is pound USD. This it's done this. I recognize this. This is what I'm expecting now, and I'm now going to wait for the market to confirm my prediction." Okay, so on that Monday, say for instance, this is London session open, comes and hits the low, creates a double bottom, goes back up again. You take your entry, your 20 to 30, 40 pips, whatever it is that you want to capture. You do that, you're out. And then market has reached New York session, comes back down, retests the EMA again, and then starts going up again. So you could have gotten out somewhere here, and then you get back in somewhere here if you're trading London, New York session. Trade this, and you've possibly by now made 20, 30, 40, 50 pips. okay, for the week. For some of you, that's probably your KPI for the week. Now, what this does is that if you've realize this with one or two currency pairs, and if you do it with one, chances are two other currency pairs possibly will be correlated. For example, if I'm recognizing this with pound USD, pound JPY, pound AUD might be correlated, right? Or AUD USD or Euro USD might be correlated as well. So once you've recognized it in one, check with the other ones and then write them down and say, okay, these are my three pairs that I'm going to look at. Because if you actually find yourself recognizing an Elliott wave structure, then you know for at least 2 or 3 of those days for that week, you'd be able to easily predict where the market is going, right? So that in itself, within one or two currency pairs, you're done for the week. You don't have to study all 9 pairs every single day. All right, so that's why I'm saying, please stick with a couple of pairs that you write down, and that's the only ones that you're going to be following throughout the week. Many of you, I've seen you guys are doing too many pairs, and that actually hinders you more than it helps you. Okay. Point number 2: trade only smooth markets. What I mean by that is that right now it's possibly not the best time to give you examples, again because it's December and markets doing all sorts of weird stuff. But when you see smooth candles, and I think I did see it somewhere, smoother candles, smaller candles with less of the wicks, right? Those are the actual trend runs that may happen, right? At any point in time, if the market looks like this, see this, what we're looking at as retail traders is in actual fact just a picture of receipts, transactions of buy and sell orders that have already happened, right? From an institutional point of view, what they're seeing on their end is just a whole heap of flashing numbers. So when you get massive candles and the candles are all different colors, all jumbled up, what they've got is just their screens flashing numbers all over the place. Those are not times when we want to be trading, right? So these large wicks, these buy sell orders, there's a lot of competition in the market of buy and sell orders happening. Stay away from it. When you're scanning through your markets, what you're looking for is the smooth runs. Those are times when a lot of the liquidity providers are in alignment with where the market's going, and so they all invest in the same direction. So as retail traders, we're really just ants wanting to take a ride on the back of like a 5,000-pound gorilla. Okay, so that's what I mean by trade the smooth markets. And in line with that, actually no, I do have corrective and impulse wave, so I'll come back to that. Point number 3: when the market is trending, don't look for reversals. I think this possibly may be the number one reason for a lot of people miscalculating the direction of the market, and then they take a trade in the opposing direction. Market possibly seemingly examples like this where you see this sort of behavior, and people will take a trade here, right? And yes, the market goes against you briefly, comes down to the EMA 50, but then pulls back and continues to go up this way, right? So in these sorts of environments, what you find yourself in is like saying, I miscalculated the entry, I was in the money briefly, and then the market went against me. So here's where I'm saying, don't actually take reversals in a market that's trending in a particular direction. Where do you actually look for them? And I'll get to that in another point, but here's a very, very important one. Please make sure that, and again, for some reason, I think it's kind of inbuilt within our minds, because I know I used to do it. Sometimes I still look at it and then I correct myself and say, why am I looking for a reversal here, right? So it's inbuilt that we see the market going up and we really want to just capture this massive reversal that happens. And each time what we find is that reversal is just a corrective wave. And then the market heads back up again, just like this, right? So we would have looked at this. And let me just assess that is, it didn't actually quite break the high of this here, right? So we looked at this market's moving all the way down south. In my videos, where I've mentioned is that you, to some degree, should be able to project where the market's going. In this case, your first and final projection would have been, or should have been, the EMA 50, right? That's still 15, 16 pips to it, Euro JPY currency pair. But a lot of people, they would have done was say, okay, this has come down here. I'm going to take this entry maybe somewhere here. I'm thinking this market's going to go this way now, right? And that's when the market goes against them. They'll probably wait for the market to stop them out. And in this case, it probably would have stopped them out by now. So again, I get back to that point. Once you have deciphered an actual trend that the market is going to continue trending in a particular direction, you do not want to look for reversals against the actual trend. Okay, wait for the market to confirm for you. And if it's going to tie in with Elliott wave structure, what you would find is, say for instance, that market does actually do a reversal, and you say, okay, this was a big reversal, I've missed it, right? What you're going to find is that this market will come back up at some point and do the 618 hit, which might also be the middle of that area here. So it will do that hit and then come back down again. So once you get your confirmation candles and the market's hit this area and done its thing, you can always get a re-entry off of that and then ride the market down. You don't have to capture the market at its highest. I've gotten so many emails this year from people that are so preoccupied with wanting to hit the market at its highest point or its lowest point and then ride that wave, and that's where they get screwed up because they've misjudged it. Okay, and you'll see a lot of videos on YouTube that talk about getting those. From my point of view, you don't have to. Let the market do its thing first. Let it confirm for you that it's absolutely done its thing and it's now moving in a particular direction. That's when you can jump in and do a safer trade. Forex isn't about being cocky where you jump into the hard trades. Forex is going to give you plenty of opportunities to just collect your pips. Remember, it's about your financial freedom. It's not about our egos to say, "Hey, I got the tough trade, so I must be a really good trader." I don't do that. For me, I don't care if I get the easy trades and get 20 pips, 30 pips. I'm done. That's what's going to make you the money. Okay? So again, please don't go against trends trying to look for reversals. Do the opposing part. So say for instance, if the market has, see in this case, market's gone up, it's come down, it's retesting the EMAs around here. We've got this EMA 800, market goes up, comes back down. So remember, good time for binary trades here because we're always expecting that the market's going to retest. And then you get this candle going up. So see these three candles here? That's a continuation pattern. That to me will say this market's going to continue, possibly continue trending up this way, right? So you could, at the open of this candle, take that entry. Now, if the market then pulls back against you and you get a wick around this area, you probably want to exit out of that trade, especially if you're still a few pips in the money. Because what can generally happen is that a formation happens, and again, if that is around an EMA here, right? And there's another rule there that applies as well to where that overall market reversal may happen. Point number 4. Ideal reversals are only those that form a complete pattern and form above or below the previous day's session, high or low, and this is most likely going to happen on a Monday, Tuesday, and Wednesday. So going back to that point that I was making earlier is, and I did see this somewhere. Okay, here it is. So basically what I'm saying here is that if a market reversal is going to happen, one which that you want to ride, and again, this would happen New York session or open of London or open of New York, right? So here, what we're finding is that, I don't know which days these were. Okay, so this is Wednesday, Tuesday, Monday. I think today's Wednesday. Yeah, today's Wednesday. So Monday, Tuesday, Wednesday. Now, what we're seeing here is that during the Asian session, market does its thing. We don't know really what it's doing. There's no clear patterns. It's bounced off the EMA 200, gone up, consolidated wicks to both sides. We're still not sure as to what it's doing. We wouldn't be trading this anyway, simply because once we look at it, this is not a smooth market. We're seeing too many skid marks, too many wicks, too many multicolored candles. It's not really moving in particular directions. There's no clear patterns that we're seeing around the EMAs. So what we do, we just observe, right? So in this case, what the market does is it goes up, it breaks the high of the previous day, right? So this was Monday's Asian session, London session, New York session. Market breaks the high, issues a pin bar to the high, and then comes back down, hits our EMA 50, goes back up and issues another pin bar right above. So see where I've dropped this line? This line is just there to measure the high of the previous day. So this market did this M formation or double top formation at just above the high of the previous day, and then it comes down. So London Open is, once it's done this is also a continuation pattern for us. That's when we can start looking for an entry going south. Okay. We could possibly even wait because there's an EMA 50 there, because for all extents and purposes, this market would come back down and bounce off of there. And this is partly the reason why I say when we see so much of the market kind of not clear, it doesn't matter how good this one looks right now, we wouldn't be taking that trade. But if this was a clear, steady move, then what you would probably find is that this candle would not have existed. You would have had maybe just a slight pullback, maybe a wick to the bottom. Hey, by the way, this guy here, I've been arguing, I don't know, guy or girl, I've been arguing with this person about Donald Trump all day. I don't know what it is, but God, people get triggered just by simple comments. Anyway, so this is a continuation pattern. Without this nonsense here, you actually would probably get a clearer pattern up here, right? But in this case, we didn't. And so New York Open, we watch to see how strong the move is. We also look to see if there is actually any news release, right? Normally, because this is against our EMAs, we'd probably not look for anything, look to trade anything here as well. Generally speaking, we want to ride the EMA, so you'd have, where's my liner? You'd have possibly like an EMA here somewhere, so the market comes, retests the EMA, comes back down, and then we take your entry there. Okay, so again, this a great trade in hindsight, but when you look at it, that right now the opposing trend run could have actually happened as well. So in order for us to limit our losses, what we do is we'll pretty much just say, yeah, this is great. Breaks the high of the previous day, previous session as well, and it created a pattern for us. But you know what? I like to only do those where there's an EMA. So for example, just quickly, say for instance, our EMA 200 was down here somewhere, and then this was the low of the previous day, where this market came down and then went all the way down below here. So let me grab this line, bring it down to this point here, bring it down, hit this mark here, or hit our EMA 200 down here, create a pattern, possibly even break this, create a pattern down here, and then start going up. That is our confirmation that this is possibly going to continue riding up for a bit, right? So those are the ones that you can trade. These also happen to be the ones where you want to possibly stay in there for longer than about 20 pips. Okay, you can ride that for say 50, maybe even plus. And if you're trailing your stops, then it doesn't really matter. You can have that going for as long as you want to. Okay. And if what I'm saying here doesn't make any sense, you're welcome to just kind of post your questions below the video and I'll try and have a look at them. All right, so look for formations only around the EMAs. This should be a key criteria for you guys, which is like your kill zones, right? So exactly what I was saying here, it's always best to look for your formations around your EMAs, because generally speaking, that's where your reversals may happen. Generally speaking, that's where the patterns will form. Generally speaking, that's where the market will come back to and then do a stop hunt, and that's where you see your wick formations, right? So establish for yourself where your kill zones are, where would price need to be at in order for you to kind of get it, well, for the market to get your attention and for you to start paying more attention to what's going on. Okay, and that in itself becomes one of your confluence points. Okay, so okay, let's do point 7 first before we go back onto point 6. So that ties in. Point 7 here ties in with always look for 2 or more points of confluence. So one of those hits, say at your EMA 200 or so, would be a confluence point, right? So let's go here. I think it was, no, not this one. No, not this one either. Okay, here, pound AUD. So notice how where there's this cross of this line that happens, and up here as well, there could have been numerous attempts for the market to reverse, right? So say for instance, we missed this. Notice how here, market here consolidates. It does what I was saying earlier, where it really breaks out up above the high of the previous day and forms a strong M pattern. Remember when I say don't try and capture the market right at the top here, let it do its thing. Let it confirm for you once it's come down here and it's starting to get back down. It's here. It's around these points here. Up here at that, let me zoom in slightly. So it'll be at these points here. See these high peaks? And then back again here where market comes and hits the EMA 50, you've got a cross here. We've got a cross that's coming here. There's a cross of these two here. Market's coming down. These are what you're going to be riding, these ones. So if you've missed this, that's not a problem. This in itself is a confirmation that this is about to happen. Okay, so again, our strongest one would be at the 200. Market goes up, you see rejection happening. Let me zoom into that one and see if we can. Okay, so this was the 50 that happened at Asian session. Okay, here. So the market, we've got a false move. We've got no idea what the market's doing here, right? Even here, it's at the 50. We don't have a clear pattern. We've just got a strong market, a red candle coming down. So we don't know that this is going to happen at that point in time. And this is when I say that you don't jump into every single trade like this, even if this was to collapse like this, simply because we're not sure and we're trying to limit our possible losses. So what we do is we wait. The market goes up. This to me looks like a bit of an M formation, but would I take a trade here? Actually, in actual fact, I did see this one. I didn't trade this one because this is about midnight Sydney my time, right? So, but look at this. Where I would have taken a trade for you guys is here. Like once the markets come down, it's hit it here. You've got all of this nonsense is complete. You've got confirmation. This market is heading south. So pound AUD entry at just after open here. This would be the first 15 minutes of New York. And I'm hoping this is correct because I haven't readjusted my ribbons since we went into daylight saving. So first candle, you're already 27 pips in the money, right? This one you can trail because it's coming off our EMA 200. So generally speaking, you should be able to capture more than 50 pips off of that, all right? And these are, your king tides. These ones here, off the 50, they're smaller run, so only about 20 pips or so. Again, I'm going to come back and make a point about that later on. So again, these are the ones that you're looking to trade. Now, if they only happen, say, once a week out of one currency pair, well, you've made your 50 pips for the week. So in a month, that's 200 pips, right? Generally speaking, you make a lot of money with that kind of pippage, okay? So again, only look for your formations largely at the EMAs. And what I mean by Confluence here, you've got your EMA, you've got the cross up here, you've got a pattern formation up here, and then also if you were able to look to see where the previous high was, which is here, and then present low, I'm going to take as being this. Use your Fib tool and let's see if it falls at a point where we recognize. So this is at 50. If we then push this down towards the low of the Asian session there, okay, so EMA it's between 50 and 618, right? So that could be another possible point of confluence. So always have maybe, what did I write? I'd say about 2 points of confluence. The more points of confluence you have, the better off you're going to be. Okay, you might use other currency pairs as well for points of confluence. So pound AUD in this case, it's a cross pair. Look to see what pound USD is doing. Look to see what AUD USD is doing. And if they, in some way, shape, or form, are doing the opposing things, there you go. You've got your another point of confluence there. Okay, so identify corrective and impulse waves. This kind of ties in with our smooth wave structure. So basically, what you want to be able to do is to recognize that, say for instance, the market's trending in a particular direction, that the actual trend will look like smaller, more smoother candles. There might be a lot of wicks going against the direction of the trade, whereas with your corrective candles, they probably got a lot more wicks to them on both sides, that they're kind of moving in an angle. So it's like where's this? That you have, where's this? Okay, so you have your your impulse waves coming this way, and then you've got your corrective waves kind of moving towards one of your EMAs with a lot more wicks to the high in this case, and then the market comes back down again. And these ones here, where where the angle of the candles isn't that great, like it's kind of more moving sideways than in a particular direction. And that's what you tend to find, that once you're in an actual trend, and say for instance there is Frankfurt session, London session, or New York session, that this is what you're kind of looking for. If the market is doing this, then at that point in time, you're not looking for an entry directly. You're looking for a specific behavior to happen around your kill zone. So the market will do this. Remember, aggressive move south, aggressive move going back up again. Now, if the market moves down here, see this area here, let's just look at that. So if for any of you, say trade the Asian session, and the market moves aggressively south this way, there's no wicks to the high here yet, would you take an entry there straight away? Some people do. And this is where they get screwed over. The reason why I wouldn't, because this actually isn't where I want it to be. It hasn't done something that I recognize. It's also, oh God, this guy's still going. So it's also at a point where early Asian session, there aren't too many players in the market right now, so volumes are going to be low. There's no clear wicks to the high. There's no actual pattern. And this could, for all extents and purposes, just continue going south. And you'd say, damn, I missed out on, say, 60 pips that would have happened. But the thing is, you've got to be able to be strong with yourself to know that, hey, but this didn't actually do what I wanted it to do, right? Again, remember, play hard to get. You need to say to the market, hey, market, I love you, but you need to come and do and really grab my attention by giving me something that I recognize, like, an M formation here, wicks to the high that I desperately need, right? So, see, this here, like, this is a confirmation for you that this is heading south. If the market doesn't give you that, you don't have any reason to jump into that trade, right? And if you do jump into trades like this without it being ideally where you need it to be, then what you're actually doing is you're increasing your chances of losses. Okay. All right. Next, where we were at. 8. If the market is in accumulation phase, expect a false move plus a pattern before the market moves. Okay. So if the market, and what I mean by accumulation phase is where the market's kind of just going sideways, it's not really doing anything. So in this case, what we're expecting is this: expect a false move, right? For us, by now, you should be able to say that if the market's doing this, we're kind of somewhat confused, because the market really needs to go back up and do a false move going towards the high. Our prediction is this market's going to continue to go south, right? So unless it does a false move to the high, it hasn't grabbed our attention. So here's the accumulation phase, candles going sideways, false move going up, and then you wouldn't exactly take a trade straight off. There are only certain times when the market goes up and then comes back down and you take a trade straight off here, and that usually is when the market's hitting a 618 reversal, right? So 618 or 786 reversal, that's the only time that I would say, okay, it's going to be straight 1, 2, 3 up, 1 down, take your trade, and the market's going to continue to come down that way, right? But for all other extents and purposes for us, what we want to see is false move after a accumulation, false move against where we think the market is definitely not going to go, or sorry, false move towards where we definitely think the market's not going to go, a pattern formation, a confirmation candle, and then we take our entry, right? You wouldn't exactly look for an entry here, even though you've got wicks to the high here, because you don't know. Like this candle here, see, the market rejected, or price rejected, around the EMA 800 and also the EMA 50. So wait for the confirmation candle. So I should have also put in here that always wait for a confirmation candle, right? Next, point 9, if EMA cross occurs on any time frame, watch for the retest of the EMA plus a pattern formation plus a confirmation candle, right? So the EMA cross itself can happen again on any time frame, because not all of you trade on the 15-minute charts. Me personally, when I had a day job, I used to trade off the 4-hour chart. So the same rules apply. That if a cross of your EMAs happen, always wait for price to come back to the EMA here. So here's the cross. Wait for it to come back to the EMA. Wait for a pattern formation to happen. Okay, so in this case, this isn't enough. This is and then a confirmation candle. Wait for the confirmation candle like this, right? The retest is usually something along these lines: a wick to the high, a wick to the low, right? So always expect that. Also, where was this here? Uh, Euro AUD today. So in this case, I didn't take this trade because my internet's been playing up, but this would have been a pretty easy 30 pip move. You would have taken it here, 3 hits to the high, right? We've got rejection candles up here as well. So after this confirmation, red confirmation candle entry goes in here, we're out of the money just briefly, and then the market comes down. This is the retest that I was talking about. So this is not a cross situation. This is just purely where price has crossed an EMA, right? So what you should expect always is a retest of the EMA. Okay, and then in this case, the next candle after that really starts coming down again. So be aware of that. But when it comes to a cross, always expect a false move towards it, retest, a wick, a pattern, so like a double top formation and a confirmation candle, and that's where you take your entry. Okay, and in this case, your entry in the first candle at the bottom of that, 27 pips. Second one, 28 pips. Third one, 56 pips. But for you guys that are still new traders, get in, get out with 20 pips plus whatever your spread is, right? If you can consistently do that, you will consistently make money through this. Okay. Right. Next. Okay, so in regards to this as well, look at previous days or weeks moves plus the location of EMAs plus fib ratios. So basically what I'm suggesting here is, say for instance a cross happens, look to see here, look to see what the market has done here, look to see where the market has come from. So if the market, you to some extent you can see the completion of an Elliott wave structure, market is hit a high and it's starting to go into reversal mode, it's come down, that's where you get the cross. That's when then you can start applying your Fibonacci tools and look to see if price has actually hit a key ratio. If it has, that's another point of confluence. So look at that, look at the previous day's moves as well. If the market's trending down, then what you want to see is that the market is establishing lower highs and lower lows, right? So this is a higher high to this one here, right? And this is a lower low to this one here, right? So then eventually what the market is going to do, it's going to come and create a lower high than this and a lower low than this. Okay, so that's what you will start to see, and that's when you then align your trades with. So in that case, you would be looking to take an entry shorting the market at a lower high, and if that lines up with an EMA and if that lines up with a Fibonacci ratio, then Bob's your uncle. Okay, point number 10. Look for significant price moves to happen around open of sessions and news releases. So if you're, whatever news release page you're following, a couple of things that you need to do. One is that look to see when the big releases are happening. So orange folder, red folder, 2 bullhead, 3 bullhead, right? And then align that to say, okay, if I'm getting a lot of red news with London Open, New York Open, and this also ties in with there's the possibility of like a cross and all of that happening, then expect the market to do false moves against the actual trend to possibly go up, hit your EMA, price rejection at that same time when the news release is happening. They might even use the news release for that purpose. Okay, so that's when you're paying a lot more attention. No arguing with people on YouTube like I do. So pay more attention to the market then. If you see a lot of price rejection and then price starts to move in the direction of whatever your prediction is, that's your entry. Okay? Okay, in line with this as well, what I want you to also to note is, like for example, with Britain and the Brexit negotiations, right? So if you're watching the news then and you're aware of like issues that are happening, watch the markets at that point in time, because if there's something significant that's happened, say during the Asian session or the day before, and by that time London's closed, then what you might find is that either in the next session or when London opens the next day, that the market is going to start absorbing whatever happened fundamentally in the news with the negotiations. So also apply some of that awareness. This person that I was arguing with, wondered why I was on YouTube quite a lot, and it was simply because of these videos and per se. But one of the things is I do tend to watch a lot of YouTube videos that are politically motivated, and by that I mean I keep track of what the European Union's doing. I keep track of what the World Bank or the IMF is doing. I keep track of anything that Donald Trump is saying or doing, any issues that Robert Mueller's investigation may have. I keep track of, say for instance, if Kim Jong Un fires a rocket or is threatening to over, say, Japan, then all of that information combined will allow you, or even things like if there's troop movements, or if DT is sending another armada towards North Korea. That investment, yes, you're kind of trying to strong arm or threaten or somehow convince the other party not to do what they're doing. But the thing is, for our extents and purposes, it's what the market believes is about to happen. So if some of those things are about to happen and the market deems one of the currency pairs weak or weaker, then we can use that information for our benefit and say, if there's something that's about to happen over Japan, the yen's going to be a lot weaker, so we can short the yen. And if what the market is doing confirms that for us, we can short it. At the same time, in this day and age, there's a lot of controversy happening all over the world. So what you need to be keeping on top of is anything that's going to cause the market to go against normal structural norms. Okay, so if you've got a clear structure and you believe the market's bouncing off the EMA 200 and it's moving up, then what you might find is that all of a sudden the market just starts shorting, say the yen starts falling. You've got no reason why. If you knew or were aware of the fact that something is actually happening with North Korea or with the US or with Japan, then what you're going to find is that you're able or better prepared to take advantage of that. And so you can start shorting the market as well. Okay? If the market trends expect breathers, expect continuation patterns. Okay, what are they? What do I mean by breathers? Basically, breathers are any areas where, say, for instance, market's trending down, and we get this sort of behavior where the market consolidates. We've got wicks to the high, wicks to the low. We've got a slight pullback happening, maybe a retest of an EMA or such. Expect these. So if you know that this market, your confluence points have been met, market's starting to head in a particular direction, and you want to kind of trade the overall market, then when this sort of behavior starts to happen, market's going somewhat sideways, expect that those are consolidated areas that are going to happen. Okay, what was the other point? And continuation patterns. So by continuation patterns, remember those three candle patterns that I was talking about. Basically, it's so if the market is trending down, you get a red candle, you get a green candle, then you get another red candle, right? That's a continuation pattern. Can I actually see this here? So when the market's kind of trending down, expect this. I don't know what this gap was, possibly a news release. This is also a cross pair, so something would have happened with one of the um, um, pairs, pound USD or AUD USD. So as a result of this, expect this. This is what is kind of designed to freak people out, and people do get freaked out. They're very comfortably in the money. Market goes against them briefly, and they freak out and they exit, possibly even out of the money. And then the market goes back into their direction. Okay, so this is something that you have to start getting used to for many of you, and this really only applies if you've got the trend down pat. If your trend is correct, your prediction, then you're fine with this, right? If your trend is wrong, then generally speaking, you're screwed. Okay, but in order to ensure that you're always with the trend, it's stick to this EMA rule that you kind of want to ride the wave with the EMAs. So see how this market hits the EMA, does its thing, and it kind of just ride it, comes back up, hits it, and then falls back down. Eventually, the market will find its way back to the EMA. Okay, we want to trade it as it's leaving the EMA. Alrighty. Next point. Abide by the 20 pip rule. Okay, this is extremely important for those traders that are new. I still get lots of emails where you guys are talking about, you were nicely in the money and then the market went against you and you lost. If you've hit 20 pips, and that's usually the first question I ask, at any point in time when you were in the money, did the market hit 20 pips? Usually, not always, usually I get a response saying, yes. So as you are learning, as you're becoming more familiar with the markets, as you're becoming more accustomed to that gut feel whilst you're live in the markets, follow the 20 pip rule. Get in, get your 20 pips, get out. Doesn't matter if the market moves 100 pips after that. What you've done is you've successfully confirmed for yourself that there is no resistance within you, within your subconscious mind, in order to, first of all, decipher the correct trend, secondly, to decipher the correct entry, and thirdly, to be able to book a profit. You've just proven to yourself you've just booked a profit. And if you can do that, just 20 pips, this is what I really want you guys to understand. Eventually, as your accounts grow, 20 pips is enough to make you very good money. Okay? So, please stick to the 20 pip rule. Do that for about 3 to 6 months or more. If you can for a year, if you're doing three trades for the week and you capture your 20 pips by 3, that's 60 pips for the week, right? So that's 240 pips for the month. That's quite a lot. You can make decent money with that. So please, if you're going to break that rule, don't write to me. Point 13, do not trade anything that is unfamiliar. Remember to play hard to get. Now, again, the whole point of all of our analysis, the auditing that we do of your previous trades, going over the charts over and over and over again, a lot of people have asked me, Shiva, why do you do this? The whole point, and to be honest with you, I still do it. You're still going to be doing it, even if you're making $1 million a year, 10 years down the track, in order to ensure that you continue being a good trader, you're still going to be doing this. You're going to go over the charts every single week, every single month, whenever you're free, whenever you can, and you're going to ensure and confirm to yourself that the markets are still doing whatever it's doing, right? I'll give you a quick example. Elliott wave structure, right? It's nothing that's new. You'll see a lot of different concepts tied around Elliott wave structure, right? But it's actually been at play even before the electronic version of trading ever came to be. Okay, so understand that the markets keep doing the same things over and over and over again. So anything that you guys go out and discover, books, courses, or anything, will in some way, shape, or form possibly use different names, but talk about exactly the same damn thing. And what we want to always ensure is that when we're trading, the market is doing exactly the same thing. So when we see these things, even if we haven't traded them, that's confirming to our subconscious mind that, yep, this is what it is. This is what the behavior is. So what you'll find is this. Okay, what you're going to find is that the next time you go and trade and the market's doing this, there's going to be this familiar feeling within you. And that familiar feeling is like, I don't know why. Look, I took my entry straight here. The market went against me, but for some reason, I didn't panic. I didn't question myself. Somehow, I kind of just knew that I'm going to be in the money, not too far in the distant future. That's what this is all about. A lot of you are not doing your homework. Go over this. Sit down with a cup of coffee or something and keep scrolling. You'll have so many aha moments. I still do it because there are going to be times when the overall structure of the market doesn't change, but they will be naughty. They will do stupid things like this where here, for example, where this is 3 hits to the high, and say, for instance, we're used to 3 hits to the high, but they might come back for a 4th hit. or a fifth hit, and you'd be like, what the hell's going on, right? Having seen that happen in the past is going to give you, to some degree, that that patient feeling within yourself to say, hey, I'm okay, I'm not screwed. Okay. Um, Pullbacks, continuation patterns. We've already done continuation patterns, price rejection. Where do these matter? So the very last thing in regards to this video, pullbacks, the price rejection we're talking about is in actual fact the wick space, right? Pullback entries, where were we? Was it pound USD? Pullback entries are, say for instance, you've got your confirmation that the market is moving in a particular direction. Usually, you've got to judge it. It's intuitive. It's not something you can say, this is a hard and fast rule. Usually, you can say, okay, price opens. Sometimes it might pop down, be a red candle, and then go back up and become a green candle before it comes back down. Intuitively, the pullback would be where price opens and then goes against you. So somewhere here, and at that point, based on experience, you could probably get your entry at the highest or the lowest point. So you could probably say, yeah, markets pull back up here at any point in time whilst it is still green. You can take an entry going south, right? So that's what the pullback is. Price rejection is basically wicks. We're looking for pin bars. Pin bars in key areas. So the question here was, where do these matter? These matter at our key Fibonacci ratio, 618, 786, 382, possibly even the 50. These matter at key support and resistance areas, especially if there is a resistance or a support area above or below our previous day's high or low, right? And if at that point in price that the market is establishing a pattern and you get your wicks to the high or wicks to the low, right? Remember, was it the EDJPY? Which currency pair was that? Okay. Can't remember which currency pair that was that I showed you. Oh, here. So here was the high of the previous day. And so we're getting this wicks, these pin bars happening, price rejection happening at those areas. And the third place would be at our EMA. So around EMA 200 in particular, you can do them at your 50. Your 50 will get you about 20 pips. Your 200 should get you more than that, right? So Jonathan, mate, in regards to the question you asked me today, and also, the maximum number of pips, yes, it largely depends on if it's a tsunami wave. So if you've hit, say, the third wave of elite wave structure, then yes, you can jump into that trade and ride that for longer than 20 pips, right? If you've hit, say, the EMA 200 and it's done a pattern, and then you're riding that wave off of that place, the EMA 200 and the pattern itself, then yes, you can do way more than 20 pips. But if it's just a hit off the 50, if it's just something that you kind of recognize and it's familiar, do the 20 pips off of that. The reason why I'm saying that is that even if the market is doing like a initial run, which might be a false move, usually speaking, again, depending on currency pair, like most cross pairs will do this, and also the pound pairs, they will go for more than 20 pips. So even if you've made a mistake, you jump in with your 20 pips and you jump out, right? So again, even if you've screwed up with your analysis, you still make your 20 pips. Usually, if you've screwed up with your analysis and you're trying to capture more than 20 pips, that's when you're pretty much dead and buried. And that would be, see here. So if there's a pullback here, market comes down. See, this isn't even 20 pips. So again, remember the analysis was also where would the market go? If it's hitting our EMA 50, yeah, you probably want to look and consider whether or not that would be a place where you jump out. If, say, for instance, and there's a safe way of doing this, so say, for instance, you jump into that pullback, market comes down, and you still think this is going to go down, and then comes back up, and it closes above the open of this previous candle here, yeah, you jump out, because that usually means the market's going to continue on. Okay, so guys, I'm hoping these tidbits help you out. If there's any further questions, if there's anything that you kind of want to clarify further, then certainly put that down in the comment section and I'll try and get to that. I'm doing some more traveling for Christmas and New Year's, um, so leaving Christmas Eve. And I possibly will not be back at work probably until about the 15th of or 16th of Jan. So I don't know what day is that. I think 16th on a Monday. So you can still email me, still be in touch. Before I do knock off, I do want to do a cryptocurrency video for you guys because some of you have scared the hell out of me where you're mortgaging your houses for to put money into Bitcoin. So I will do a video around that for you. Alright, guys, this is long enough. So if you don't hear from me, Merry Christmas and Happy New Year to all of you. I'm hoping you have a blessed day and holidays with your loved ones. And also, please, when you get time, sit down and start drawing out your plans for 2018. Maybe jot down some goals. Um, and hopefully next year we can do bigger and better things, and I'm going to be more connected with the trading as opposed to the spiritual stuff. All right, love you guys, and enjoy the rest of the year.